investing when we don't want to be too much exposed to the market. That's very nice. Thank you. So we have taken from the classic strategy, we have taken the satellites. We have no correlation. We have taken the satellites and put them into a core. You understand that? So we took the core and we put all products which have no correlation into. So we have then the clean tech, we have then agrar leasing, we have there some US life settlement products, we have CTAs, we have other alternatives. We put all the fund of fund portfolio which has no correlation and which has a very high monthly positive performance. We have created two fund of fund portfolios. One is more income and one is more opportunities. Both have, over the last 5 years, about 65 to 110 basis points a month. Steady growing. We have, not in 2008 and not in 2011, we had a minus. It was always steady growing. But this is not what I wanted to tell you. It is important that you find the way to invest that you are not exposed to the market. If you're not looking about it. I think the best of it is, if you have risk, we have everywhere. There is no free lunch, and you just have to find for your strategy the way how you can either accept the risk or be aware of risk. If you accept the risk, you get more exposure to the market. And if you don't accept the risk, if you are aware of risk, then you find the strategy of no correlation to the markets. If here, in this alternative strategy, it is special that the satellites can be everything. The satellites can be, if we see on the left, you have the core, on the right you have the core, as we said, products which have no correlation. On the left, the satellites, again, 1/3 of the capital invested. Here, you find everything. You can get back to the markets and get on a low-cost basis ETFs and manage, diversify on a global side. You may as well buy long-short equity, as we have heard today, the hedge funds. You can invest in long-only products. The thing is, on the satellites, this is the opportunity that you are getting back the smart exposure to the market. If you are talking about core satellite strategies, we want to find the best of both worlds. We have heard a lot about active managers, real estate, alternatives, hedge funds, microfinance. These are all active managed funds. And this is exposure to the markets. So you have to accept the risk, or you get out of the market and you take no correlation products. So, the second topic I want to talk to you is our indices. We have developed indices. A second. I'm very sorry. I said before that for the classic strategies, we use ETFs. We were thinking about which are the best ETFs to find. Shall we take MSCI World and then take from BlackRock an ETF on MSCI World? Is that the best? Well, we have a diversification over the whole world. We are in equities. That could be fine. Or how could we do the best to act for our clients? Well, first we have to know what is the target of our client? Okay, that we could find out because we know our clients, or we ask the clients if they're more defensive, are they more close, are they balanced investors, would they like to invest in Europe, would they like to invest in Asia? Okay, how can we combine this? And so we get the idea to develop GLAXX indices. What are GLAXX indices? As I said, it is a global asset allocation indices and can be used for benchmarks on the one side, and we bring it in for the basic of the ETFs that we are structuring. So we have taken the 5 main asset allocation: equities, bonds, real estates, hedge funds, and commodities. All what we have heard today. We are taking the five asset classes. We have put them together in two parts: income assets and growth assets. We defined real estate and bonds as income and growth as hedge funds, equities, and commodities. So we can very easily define strategies which are defensive, 75% income, 25% growth, or balanced, 50-50, and the opposite for growth. Saying that, we have taken for these 5 asset classes, we have defined 13 sub-indices, 13 indices, global indices, where we can compose our own index. Voilà. Saying that, we have some 5 equity indices, 5 bond indices, and each 4 bond indices. We have a commodity index, a gold index, a real estate index. These are the 13 indices where we have composed. Now, as said before, we have 3 risk-return allocation: defensive, balanced, growth. And we have put it into the indices. So, what we have out of these indices? We are able for structure for every demand or request of our clients a certain portfolio. If a client invested in Europe and he likes balanced, we put on the bottom, and we get all the indices structured into 50-50, income, growth, and the relevant indices out of our defined portfolio. Let's look about what it has done. This, we have, saying that, we have back-tested this to 1995. And the most, what it makes interesting to know is that balanced and growth are very, very close together. What does it mean? It means that even if you take more risk, because you have 75 growth and 25 income in the gross risk-return profile. You're only a little bit better than in a balanced portfolio. This was the main impact of our research and out of our creation of the index. It is not, well, let's say if we would have done it back to 1965, we may have maybe a larger difference between balanced and growth. But I can tell you, the last 17 years, and that's where we all have invested money, were the years of balanced strategies. Also, it doesn't, all those who were heavy invested in equities have find some very bad years. So, coming back to what I said at the beginning, the core should be your basic strategic, your basic strategy, sorry. And out of that, you find out of this back testing on global indices, on 17 years that we back tested it, balance is less risk and has somehow the same performance as growth. So if you hear from your grandfather and from your father, so you say, that equities on the long term is better, then he might be right. Because the years before were different. If you take a longer term, it might be different. But the last 17 years, balance has somehow the same gain like growth, but less risk. What does it mean? Okay. If you see, for example, the comparison between our core strategies and BVG 25 plus, I have to explain this. In Switzerland, Bank Pictet, which is one of the largest Swiss private banks and very sophisticated asset and manager, they have developed I would say some 15 years back, a benchmark for the pension fund industry. I cannot say that we have covered this, but we have somehow done similar, but we have done it globally. And that's why we went and have compared our main indices to that from Pictet, the defensive one. Pictet BVG 25 plus means 25% equities or the growth and 75 income. And over 17 years, we are about 4% difference. So we can say the Swiss market, just as a comparison, the Swiss market has over 17 years the same performance like global. So it doesn't matter, actually what I want to say is that it doesn't matter how you are invested, it matters that you are somehow balanced invested, or that you have your own strategy, your own focus, and you're holding it. How long? 5 minutes? Okay, sorry. I'm a bit slow with speaking. Huh? Also, that we can leave. Very short. Coming to a very short end. Prosperous Group is a developer of new products and actually for institutional investors. And we have tax and wealth asset management for private clients worldwide. Myself, I have been the last 3 years in Russia, in St. Petersburg, and I have developed with the largest information platform in Russia, the first platform for global funds in Russia. we are now transferring that onshore market into an offshore market and give them the opportunities to invest all the global funds that they see on the platform